Hello, everyone, and welcome to the updates to the NCUA's Interest Rate Risk Supervisory Framework Stakeholder webinar. This is Tom Fay, Director, Division of Capital Markets from the Office of Examination and Insurance. We're hosting this webinar as a follow-up to Chairman Harper's letter to credit unions on updates to the IRR Supervisory Framework issued on September 1st, 2022. Before we begin, I will cover some technical tips to make sure that you can see the webinar console and hear the presenters. First, all attendees will be in a listen-only mode. Second, if you have questions, you can submit them at any time during this session using the Q&A button located at the bottom right corner of your WebEx console. To submit a question, simply click the Q&A button, type your question into the box provided, and then click send. We will do our very best to get to your questions as time allows. Third, if your volume sounds too low, check to make sure that your volume is turned all the way up on your computer. If that does not work, you may have to plug in external speakers. Fourth, closed captions will be available within the WebEx. To enable captions, click CC in the bottom left of the console. And lastly, we've provided a link for you to download the material we are presenting today. We are also considering creating an IRR resources page on the NCUA website for you to gain access in one place for all IRR important documents, guidance, letters, supervision procedures, and other documents such as this presentation. Thank you. And now I would like to introduce the NCUA Chairman Todd Harper, who would like to welcome you and say a few introductory remarks. Thank you, Chairman.
Thank you so much, Tom, and hello, everyone. I'm pleased that all of you are joining us today, and I appreciate your interest in this webinar on a very important and timely topic, managing and mitigating interest rate risk. Let me first thank Kelly Lay, the Director of the NCUA's Office of Examination and Insurance, and her entire team for developing the updated interest rate risk framework and for coordinating this online event. You will receive valuable information today designed to advance your understanding of the changes to the interest rate framework detailed in our recent letter to credit unions just 2 weeks ago. With the emergence of persistent inflation and the Federal Reserve's ongoing efforts to contain it, the NCUA is concerned with how the rapid surge in interest rates could potentially impact the financial condition of your credit union. But we also recognize that you may have concerns about how the NCUA will supervise for interest rate risk in this environment. In fact, I have heard from several credit unions over the last 2 weeks on that very point. So I want to assure everyone today that we are providing separate training, guidance, and support for our examiners. These efforts will ensure the effective implementation of the updated interest rate risk framework. Our goal is for NCUA examiners to implement the new examination procedures and framework in a uniform way. Given the uncertainty around interest rates and the overall economy, this is a time for your credit union to be vigilant in its risk management efforts. As I often mention in my public statements, your credit union's ability to manage interest rate risk remains a crucial factor in its performance. The surge of interest rates so far in 2022 is an event we have not seen in decades, and these changes may introduce many interrelated risks. As a result, your credit union must pay careful attention to the fundamentals of capital adequacy, asset quality, credit, earnings, and liquidity in the months ahead. And if you have not already done so, I urge you to carefully review the supervisory letter, as it will help you to better understand the NCUA's expectations for managing interest rate risk. Finally, I should remind everyone joining us today that interest rate risk is a supervisory priority for the NCUA in 2022, and interest rate risk will continue to be a supervisory priority for us in 2023. The efforts of your credit union to manage and mitigate interest rate risk will not only ensure the long-term success of your credit union, but it will also protect the share insurance fund from future losses. In the past, like during the savings and loan crisis, we have seen what could happen when a financial institution fails to manage this risk. We need everyone to act now to prevent future problems so that the credit union system can continue to achieve its statutory mission of meeting the credit and savings needs of members, especially those of modest means. In closing, I encourage you to make the most of today's webinar by asking any and all questions that you may have. In fact, we set up today's event to answer as many questions as possible and to alleviate as many concerns as possible. If you should have any additional questions or concerns on the updates to the interest rate risk supervisory framework that are not addressed today, I encourage you to contact the NCUA's Office of Examination and Insurance or your regional office. Thank you again for joining today's webinar. As always, be safe, be well, and be kind. I'll now turn the program over to Kelly.
Thank you, Chairman Harper. This is Kelly Lay. I'm the Director of the Office of Examination and Insurance. As Chairman Harper mentioned, I also want to thank the E&I staff for their efforts in drafting these updates to the interest rate risk supervisory framework. Updating any supervisory procedure ordinarily could be a lengthy, analytical, and deliberative process. Understanding and factoring in all stakeholder inputs is important before we can confidently issue examination procedures to staff. The assessment of risk should never be a one-size-fits-all. These interest rate risk supervisory framework updates restore the original intent of the 2016 revised interest rate risk supervisory framework in determining the scope of the examination and preserving the judgment of the examination team in determining the S rating for CAMELS. Quantitative measurements can be helpful in many ways in dimensioning the industry and identifying outliers. While the NEV test and ENT will still help the NCUA do just that, we've changed our approach to ensure the risk classification alone will not be used to issue a document of resolution, also known as a DOR, requiring a de-risking plan. However, as with any examination, this does not preclude a credit union from receiving a DOR if the circumstances warrant one. These interest rate risk supervisory updates are not only the 4 items the team will brief you on today. The team will also discuss updates to the examiner's guide, the interest rate workbook, and supporting procedures. The team is also conducting staff training, which undoubtedly will continue for the foreseeable future as both the path of interest rates and the economy remain uncertain. Next slide, please. I'd like to reiterate the chairman's remarks on the significant progress over the past decade the agency's made on the supervision of interest rate risk. It's important to know the NCUA has taken considerable steps over the past decade through new regulations, the ability to hedge interest rate risk, and isolating the sensitivity to market risk by adding the S in CAMELS. The updates we've made this month are refinements to the 2016 letter and will maintain, if not only to adapt to the current environment, but to increase the effectiveness of the NCUA interest rate risk assessment. We've included a reference to numerous resources toward the end of this presentation, of which many can be sourced on the NCUA website. I will now hand it back over to Tom, who will go over the agenda for today's webinar.
Thank you, Kelly. And also thank you, Chairman, for your remarks today on this important topic. For today's webinar, I will review a couple of market and industry observations, and then I will hand it over to my colleagues to review the IRR supervisory updates and the Q&A. Next slide, please. So needless to say, 2022 has been an interesting year thus far, given the changes in interest rates and the uncertain economic conditions. As Kelly mentioned, we're updating the IRR supervisory framework to account for an unprecedented combination of events, of which all are contributing factors to the increase in IRR risk classifications. As for those contributing factors on the left side of this slide, for credit unions, the industry's total asset growth since December 2019, pre-pandemic, has been significant at approximately $570 billion, or 35%. This, coupled with a low for long interest rate cycle, has contributed to declining net worth ratios and also, in some cases, decreased earnings. Also, the industry as a whole has invested some of this excess liquidity into longer duration investments. Investment balances are 9% higher just from a year ago. With that backdrop, layer on the unprecedented upward movement in interest rates with uncertain economic conditions, all adding up to a combination of factors contributing to the results on the right side of the slide. Hence, lower net worth ratios. While capital itself may have continued to increase, the leverage ratio declined given the increase in total assets. 2, lower NEV ratios. Net economic values in the NEV supervisory test, or the END, have been significantly lower. We've seen an increase in extreme risk levels in the NEV supervisory test. We all know we've seen an increase in the doors, which we are addressing, and of course, those associated de-risking plans. Bottom line, we've had to consider many factors in updating the IRR supervisory framework. Next slide, please. I previously mentioned and referenced the surge in interest rates because we haven't seen an increase over a 6-month period in decades. And I'm referring to the movement between December 2021, the bottom line, to the June 2022, the middle line. And essentially, the movement between the 2-year and the 10-year point, we haven't seen this kind of movement in a 6-month period since the middle 1980s. And the percentage increase in the shorter than 2-year point are unprecedented. Next slide, please. I referred to the impact on the rising rates to the financial condition of a credit union. For example, allow me to profile an observation given the change in interest rates this year and the increase in investing into longer duration instruments. This chart trends the unrealized gain losses for available for sale securities as a percentage of net worth over the last 10 years for federally insured credit unions. As a result of the surge in interest rates in 2022 through June, and the potential extension of duration given the increase in investing of longer maturities, unrealized positions have dropped significantly in price and, as reported in the Q2 call reports, representing close to 13% of the system's net worth. This may present credit unions with alternative liquidity and funding challenges going forward, but highlights, just as an example, how examiners will holistically look at interest rate risk and liquidity risk. Unrealized gains and losses are not considered for regulatory capital until sold, and then, under the current circumstances, would reduce retained earnings and resulting capital ratios. Credit unions may be faced with a difficult decision and may not consider the liquidation of securities as a funding option given the potential losses. It will be important for credit unions to analyze and understand how they will manage through this interest rate cycle with potential impacts to earnings and capital. What funding alternatives are available at what cost? And lastly, how will these underperforming assets factor into the credit union's projections? This situation may be exacerbated even further for the third quarter as interest rates rise even further. Not related directly to IRR, but worth noting given the market dynamic, federally insured credit unions with more than $250 million of total assets are required by Part 741 of NCUA regulations to have a contingency funding plan, or CFP, and at least one contingent federal liquidity source. While this may be one example of the potential impact of higher rates on credit unions' financial condition, we urge credit unions to be disciplined in managing all risks during these times. Thank you, and with that, I will now hand it over to Jonathan to discuss the updates to the IRR supervisory framework.
Thank you, Tom. I'm Jonathan Farrell, Senior Capital Markets Specialist in the Office of Examination and Insurance, and I'll be discussing the 4 updates that the NCUA has made to the interest rate risk supervisory framework referenced in the supervisory letter. The first update, and the most noticeable change occurring in the interest rate risk supervisory framework, is the elimination of the extreme risk classification and the modification of the high risk classification. These updates flow through the required actions previously associated with the extreme rating. We'll go into greater detail regarding what circumstances may still require issuing a DOR or other supervisory action, what the factors are for determining a risk rating, and when examiners may deviate from the NEV test for the risk rating, and what factors will guide the decision in coming slides. Many of you are curious as to whether we will be making other adjustments to the risk classifications or assumptions in the NEV supervisory test. While we are continuing to evaluate this, we will not be updating the non-maturity share premium assumptions or the risk classification percentages in the supervisory test at this time. The updates to the interest rate risk supervisory framework restore the intent of utilizing a quantitative measurement to dimension the industry's quantitative interest rate risk, as well as identifying outliers. Changing any assumptions or risk classification percentages would and should not change how we scope the examination of credit unions for interest rate risk. In summary, the extreme category no longer exists, and the risk classifications are low, moderate, and high for both the NEV supervisory test and the ENT. Next slide, please. The second update is that we are eliminating the presumed need for a DOR and a de-risking plan based on the result of an NEV test or ENT risk classification. While we've removed the automatic DOR with the elimination of the extreme rating level, deficient risk management practices or unacceptable risk levels must still be addressed. Secondly, credit unions are not required to have a plan of action when they are in high risk classification. The high risk classification determines the scope of examination steps, which then may result in a required plan of action. Hence, the determination will be on a case-by-case basis. However, the decision to go that route should entail a wider analysis of the risk position, management practices, and the timing of the risk. There is a distinction between the interest rate risk rating, one of the 7 risk ratings assigned to the credit union, and the S in the CAMELS. For interest rate risk rating, it reflects the heightened expectation of credit unions in demonstrating how they are managing interest rate risk and the related risks during a time of uncertain markets for interest rates and the economy. The examination procedures align with the S component rating factors that are defined in the S rating of CAMELS. Examiners are empowered to take a holistic view, supported by well-documented analysis, and make tailored actions that account for the unique characteristics of an institution. Bottom line, DORs may be used when a credit union needs to act, or in some cases to preclude some action needed later, but it will be determined on a case-by-case basis. Next slide, please. We're providing some high-level examples of when a DOR should be considered, but we know every case is different and will be left up to examiner judgment and the specific circumstances. While examiners have been empowered to take a more holistic approach, that does not mean a less stringent or less effective examination of interest rate risk. There are clear boundaries when it comes to risk to the share insurance fund, as well as requirements laid out in Appendix A of Part 741, among others. These will still be strictly enforced as they were under the prior letter from 2016. In instances where the risk level is not commensurate with the risk management practices, even at a low or moderate level of risk, enforcement actions may still be necessary and a DOR may still be appropriate. Bottom line, examiners are focused on determining if a credit union has updated their risk management approach to the higher rate environment, and if the changes they made are appropriate for monitoring and controlling their material risks. Examiners will determine if an institution can manage the interest rate cycle without taking drastic measures, as could be the case when there's a higher probability of a significant impact to earnings or capital. Next slide, please. We've also listed a couple of examples of when a DOR may not be necessary, as we're able to account for more of the complexity, unique circumstances, and market forces that may impact a credit union's financial condition. The examples provided illustrate the point that inherent risk alone is often insufficient to assign a rating under the interest rate risk supervisory framework, and that it's the use of commensurate risk management practices that match or exceed the level of risk that will help define the final rating for the S in CAMELS. But when the institution is appropriately identifying, measuring, monitoring, and controlling risk, we have the means to ensure the corrective action does not exacerbate the identified issues and distract from a good management strategy. Bottom line, as I stated previously, doors will only be used when the credit union needs to take action, or in some cases to preclude some action needed later. Next slide, please. The third update we're making to the interest rate risk supervisory framework is adding the ability to change the interest rate risk rating derived from the interest rate risk workbook results. Examiners may adjust up or down the rating relative to the rating provided by the ENT or NEV supervisory tests. However, while examiners will now have this ability, varying from the rating floor from the NEV test should be relatively uncommon. Changes will entail additional review, though that will be more comprehensive for upgrades than for downgrades. This is also more likely to happen at the margins of a risk rating, where smaller adjustments could have led to an arithmetic change in the test. Though it can occur in outlier cases, that will be far less common. As I previously stated, there is a distinction between the interest rate risk rating, one of the 7 risk ratings assigned, and the CAMELS rating. This means that while the risk rating may be high, strong risk management of that high risk can be favorably represented in the S rating in CAMELS. In summary, a high rating means the credit union's NEV test resulted in high risk classification or was increased to high given other risk management deficiencies according to the NEV test. The high rating triggers an expanded set of exam review questions that the examiner will use as part of the interest rate risk review. This is particularly important given the current volatility of interest rates and the economy. If the credit union is independently calculating the NCUA's NEV test, then the expectation of what examiners will be reviewing will better assist credit unions in preparing for the examination. What the high rating doesn't mean is that an automatic door will result from the NEV test, that it will automatically require a de-risking plan, or that the NEV rating will necessarily translate into a low S rating in the CAMELS as the CAMELS rating. As I previously mentioned, the CAMELS rating is a holistic assessment of the credit union's interest rate risk program. Next slide, please. The fourth update is to the interest rate risk workbook examination procedures. These updates contain review steps to assess how a credit union's management is adapting to changes in the economic and interest rate environments. The revised examination procedures contain 4 changes. First, a new tab describing how examiners should consider the source of high interest rate risk. The driver of the high interest rate risk is an important factor in evaluating interest rate risk. Management actions to move interest rate risk into the high category will generally reflect more negatively on a credit union's management than the interest rate risk migrating to high due to changes in the market rates. 2, assessing risk management and controls of the credit union. A credit union with strong risk management and controls and high market risk will be looked at more favorably than a credit union with average or weak risk management practices and controls. Third, analyzing the potential impacts or earnings and capital caused by high market risk. Credit unions should consider the impact on credit, liquidity, and other potential risks at their credit union. And lastly, determine if the credit union has sufficient earnings and capital to support the high interest rate risk. The interest rate risk workbook has a new tab for a job aid for high market risk. We've attached a copy of the interest rate risk workbook in the linked materials. Next slide, please. As per Kelly's earlier remarks on resources, see the links for your benefit. Most of these are also available on the NCUA's website. That concludes our presentations, and I will now turn it over to Susan, who will coordinate the Q&A session. Susan?
Thank you, Jonathan. Good afternoon. This is Susan Brown. I'm a systems officer from the Office of Examination and Insurance, and I will be coordinating the Q&A session. So let's start with our first question. The first question is, what is NCUA's position regarding DORs issued just prior to the release of the new guidance, where the cause of high interest rate risk and DOR are due to reasons mentioned in the guidance that will no longer warrant a DOR? Will NCUA rescind those DORs?
Hi, Susan. This is Vicki Narwald, Associate Director in the Office of Examination and Insurance. I'll take that question. So the NCUA is in the process of reviewing all of the documents of resolution that have been issued for extreme interest rate risk in 2022 and making a determination whether they are applicable or no longer applicable based on, the underlying factors. So you credit union should hear from your examiner or the region to let you know. But if you do have any questions, please reach out to your examiner, or in the case of a state charter credit union, your state supervisor, if you have any questions. Thanks, Susan. Back to you.
Thank you, Vicki. Okay, next question. Is NCUA considering changes to the limitations on the non-maturity deposit premiums in the NEV supervisory test that contributed to the increased risk classifications?
Hi, Susan. This is Tom Fay, and I'll take that question. This has been a very popular question, of course, over the last few months as NEV tests have migrated into the extreme risk classification, and of course from moderate to high. So it may be beneficial for the attendees if I spend just a few moments just to summarize our position on the supervisory test and standardization of those non-maturity shares. So let me take a moment to discuss why NCUA is standardizing the treatment of non-maturity share values in its supervisory test model. Non-maturity shares continue to be a major funding source for credit union operations at approximately 70% of total assets for the industry as a whole. The major reason for the standard amount of premium is that there exists a significant degree of uncertainty surrounding the assumptions that depositories, banks, and credit unions alike use when establishing estimated values for these accounts. By definition, these shares have no contractual maturity, and the member can withdraw them at any time and receive full face value, or par, as we say in the valuation discipline. Practitioners frequently use a historical regression analysis to assign an average life to non-maturity accounts, as well as an interest rate sensitivity factor that explains the behavior of the account in response to its pricing relative to market interest rates. Said another way, practitioners use past behavior to predict what accounts will do in the future. Now, in fact, NCUA has issued guidance on this subject and does expect credit unions to conduct thoughtful behavior studies on non-maturity shares and sensitivity analysis around their assumptions because they represent a key driver of risk in the balance sheet. As I mentioned, there is a significant uncertainty surrounding valuation methods. First, there is the risk that the past may not do a good job of predicting the future behavior because of new factors that are outside of the model parameters. We call this an out-of-sample forecast risk. Rates have been relatively low over a long period of time, decades in fact, until recently, and this may weaken the regression approach as a predictor. The last financial crisis/recession caused unprecedented disruptions in funds markets and precipitated large-scale flights to quality. Credit unions experienced a similar surge of inflowing shares during the pandemic that remained on deposit with rates stuck at very low levels. These funds may possess substantial sensitivity to subsequent market events and turn out to be volatile in nature. Lastly, technology developments make it easier than ever to shift money from one institution to another, and tech-savvy consumers are a growing percentage of the member base. All of these factors suggest that the future deposit behavior isn't knowable, and that NCUA must employ a constrained approach in how it values these shares within the SOUP test, regardless of how credit union assumptions treat them. I mentioned previously that non-maturity shares represent more than 70% of today's funding for credit unions. The materiality of the underlying model risk associated with assigning non-maturity share values is therefore very significant. This means it represents a key driver of risk inherent in most credit union balance sheets and income statements. We ultimately determined that a non-maturity shares would be assigned a small degree of value benefit, which is value above par, to acknowledge some amount of core deposit intangible is probably intrinsic in many of these accounts. We simplified our model by choosing a single value of 1%, which may apply to base value of all non-maturity share accounts. The shocked value is derived from that 1%. Standardizing the value of non-maturity shares for the supervisory test isn't a replacement or an attempt to value credit unions modeling for their member accounts, but provides the NCUA with the tool to dimension the duration mismatch using the NEV. Lastly, the IRR examination doesn't exclusively consider the NEV results as a sole determination for the S rating, as earnings at risk and the overall risk management of the credit union's IRR management are equally important factors. Thank you, Susan. I'll turn it back to you.
Great. Thank you, Tom. Our next question is, what maturity term in years does NCUA consider longer duration?
So Susan, this is Rick Mayfield, and I'll take this question. So historically, NCUA has looked at 3-year and longer investments as being longer average life, and it's not a duration, it's really a average life calculation. And on top of that, those were fixed rates. So floating rates would not fit into that, because from the standpoint of interest rate risk, floating rate securities generally don't have the same amount unless there's a weird index or an inverse index. But historically, it's 3 years or longer. And for maturity, I think from the standpoint of interest rate risk and just, thinking at it purely as a duration measure, not an average life, it would be somewhere between 3 and 5 years where it starts to get a little bit longer. But historically, NCUA does view a 3-year or longer as a longer average or more complex investment as far as the maturity term. And that concludes my answer.
All right. Thank you, Rick. Our next question is, if we have already been audited a month ago, will our audit be changed?
Hi, Susan. This is Kelly, and I will take that question. What I would say is that we don't plan to re-examine for interest rate risk under this new supervisory framework, even if you were examined under the previous framework. But if your credit union did receive a door for extreme interest rate risk under that old framework, just as Vicki said, the region will be determining if the door is still applicable and will notify your credit union of the status. That concludes my response.
Thank you, Kelly. Next up is, when will a new workbook be available on the website?
This is Brian Heitman, and I can take that question. So everyone should, at the links that we provided in the Q&A, be able to access the workbook, but we will also be posting that to the website. We are right now working through the possibility of creating a dedicated IRR web page. But in the meantime, we will update that workbook on the website, hopefully in the next week or so, but soon as we can. And that concludes my response. Back to you, Susan.
All right, thanks, Brian. Our next question is, If we're in high or extreme risk, should we notify our examiner in advance and explain what we're doing to address?
Hello, this is Jonathan Farrell, and I'll address that. Yes, the best course of action if you find yourself to be in a high risk rating is to communicate that with your examiner in charge, both through your state agency as well as through the NCUA. The more information they have prior to coming on site for an examination will allow them to set up the right type of resources, either additional time to review it, possibly being able to review whatever you provide prior to them coming on site, so that you can be, assured that they have the necessary time and resources to review what you're looking at and then come to a decision, so that it's not a kind of race there once they get to the examination process. So the earlier you can communicate, the more thoroughly you can get that discussed and kind of go back and forth, so that you can come to a resolution, hopefully prior to them needing to come on site to discuss. Thank you.
Okay, stick around. I think the next one is yours also. So how does NCUA reconcile using the NEV supervisory test, which is only guidance and not a regulation, and enforcing bright light risk metrics in part to justify doors, when NCUA Regulation 791 Subpart D specifically states that NCUA will not use bright lines or issue doors in regard to violations of guidance?
Thank you. This is Jonathan Farrell again to address that question. I think this letter was specifically designed to help get back to the original intent, that this individual test would not be setting a door or a risk rating. We've explicitly taken out the requirement from a door as determined by a particular risk rating, and gotten back to a more holistic approach that allows the examiners to take the supervisory tests in conjunction with other factors all into consideration in making the final interest rate risk rating, as well as the final CAMELS rating. So to answer your question, we don't want to, and we're specifically trying to get away from the concept that an individual factor is going to lead to a door, when in actuality, we're going to take a more holistic approach that's going to take into account both your quantitative and qualitative factors. Thank you.
All right, thank you. Next question. There is a concern that some examiners may arbitrarily change the interest rate sensitivity since they have the ability to do so. What options does the credit union have to appeal a change?
Thank you, Susan. This is Vicki Narwald, Associate Director in the Office of Examination and Insurance again. I would suggest, first of all, discussing it with the examiner, and then the supervisory examiner, and then ultimately, if the change results in a material supervisory determination, then the credit union has, the rights afforded them under Part 746 appeal procedures, and they can follow the process for appealing that supervisory determination. Back to you.
Okay, great. Rick, I think we're going to give the next one to you. Why is the threshold 250 million in total assets for an institution to have a contingency funding plan, and 500 million in total assets for an institution to utilize derivatives without having to submit an application for approval to their regional director?
Thanks, Susan. This is Rick Mayfield again. First of all, a CFP or contingency funding plan is required for a credit union over 50 million. So I think the 250 has to do with the federal liquidity source. And that was done back in 2014 because it was determined by the board that those credit unions above 250 million were very interconnected with other market entities. So they felt that was the appropriate threshold. The derivatives rule came out about a year ago, maybe a little bit longer, and the new rule no longer required an application for all credit unions, and complex credit unions that, or credit unions over $500 million that had an M component of 1 or 2, they could just do a notification within 5 days of their first derivative transaction. So the derivatives was based off of 2 things. It was the line was drawn because of it's a complex credit union, and that market interconnectivity was not considered from that standpoint. And that was also the line for a credit union to do RBC, and then more recently they can opt into the cooler. But on top of that, there's a management component of 1 or 2 required for them to give to not have to apply. If they have a management component of 3, 4, or 5, they still have to apply. So these are very different. These are different approaches that we took for different reasons, and it's not as if a credit union can just do derivatives if they're over $500 million. They have to have a management component of 1 or 2. And then back to the federal liquidity backstop, that was based on the fact, as I mentioned, that the credit unions over $250 million or more interconnected with other market entities. So that's how that was determined. That concludes my answer.
So the next question we have is, will there be increased pre-exam coordination with SSAs and NCUA EICs for state chartered credit unions to allow EICs to be better prepared for how IRR reviews will be done based on the updates discussed today?
Hi, Susan. Vicki Narwald again. I'll take that one. So actually, we have been coordinating with the state supervisory authorities all along in this process. We have had discussions with them as we've been developing the guidance, and we have included state examiners in our training that we have provided to the NCUA examiners. So they're receiving the same training that our staff is, and they also receive the same supervisory letter that our staff did. So they have the same information, should be on the same page, and then there is an expectation, of course, that our examiners will be coordinating up front prior to the exam. So hopefully that helps answer that question. Thanks, Susan.
Okay, thank you, Vicki. All right, next. In the calculation of the net stable funding ratio, NSFR, the FDIC, OCC, and FRB recognize that over 90% of fully insured retail deposits are long-term and stable in nature and proper for funding long-term liabilities. The NCUA's treatment on NMDs is a material departure from this perspective. What is this based on?
Hello, this is Jonathan Farrell. I'll be answering that one. Looking at the calculation of the NSFR, I think that you might have an incomplete picture of the way that FDIC, OCC, and Fed examiners review the liquidity position related to the stability of those types of deposits. There's actually an additional funding concentration page as part of the reports for each one of those agencies that relates to certain structures in their funding. So for instance, whereas we look at all of the shares somewhat homogenously, they tend to review them in different terms. So they review them relative to their high rate determination, which if you ever want to look at what the high rate is for most types of accounts, you'll find it's much lower than you probably thought high rate was. In addition to that, there's uninsured deposits, large depositors, a slew of other things that go into the analysis of that then combines into what they call a potentially volatile funding sources, which is a separate concentration. So while they have included the NSFR and incorporated the largest percentage of the remaining deposits into those categories, there's actually a substantial proportion of those deposits that aren't counted into that category in the first place, and they're considered a potentially volatile funding source that usually encapsulates anywhere from I'd say on average, somewhere around 50% of funding, maybe, even at a relatively stable institution, you're still looking at probably closer to 20 or 30%. I have a federal commission with the FDIC. I used to do this exclusively, so I'm aware of the way this process works. But if you're just looking at the NSFR, you're going to get an incomplete picture of the way that those types of funds are accounted for. And when you look at the more holistic picture, I think you'll recognize that even though we come at it from different angles, the proportion of overall deposits or shares that we account for as stable is relatively similar. Thank you.
All right, thanks, Jonathan. Our next question is, could you please give us a couple of examples of strong risk management in the extreme low rate environment and suddenly surge in interest rate?
Yes, as a matter of fact, this is a good question, because one of the things that we did with the update to the supervisory framework is add some color around strong risk management controls. And so if you look at the workbook, we have added a new tab, and I believe it's called tab J, and J is what we call the high IRR job aid. And in that job aid, we profile 4 different areas that examiners will focus on given today's interest rate risk environment. And the second one, I should say, is risk management and controls. Now, while not limited to these characteristics, but we have profiled what is strong, satisfactory, and deficient for examiner to consider. We already had a fairly good explanation on how to assess this in our examiner guide, which is also a public document on NCUA's website. But given the current environment, we wanted to provide more information on how to assess this. And so we appended the workbook with this tab J. So take a look at that. I think that'll be helpful for credit unions to understand what examiners are going to be looking for in this environment. And I hope that helps. Thank you, Susan.
Great, thank you. All right, just a reminder, if you've got questions, please send them in. We've got a whole team here, so we will address them as soon as we can. Let's see, I know some people have been looking for the link, and they're saying that the link in the handout is not working. If you send us in your emails, we will try to email them to you. Let's see.
Hey, Susan.
Yes.
There was a question earlier, and in fact, I'm going to reword it a little bit because I think it's an important item for credit unions to understand the distinction between, and Jonathan made reference to this in the slides, but it's probably good to repeat it a little bit on the distinction between an examiner assigning a risk rating, which is one of the 7 risk ratings that examiners use in their assessment, and the S in CAMELS. So as credit unions already know, NCUA now utilizes the S in CAMELS, which was effective April 1st of this year, to assess the sensitivity to market risk, was essentially primarily interest rate risk. And there's a distinction between the two. As we know, we're going to use the supervisory test to help us trigger, not supervisory actions, but trigger what the examiner should be doing in terms of its interest rate risk assessment. That hasn't changed, but because of the extreme risk classifications, we had to calibrate that back so we would restore the intent of our original supervision from 2016. So to repeat, an examiner may see a high in the supervisory test, and all that does is trigger additional review steps they need to take in as part of that examination, which may lead, okay, there's no automatic door, but it may lead to a door if they assess and see deficient risk management or excessive risk in the credit union's balance sheet. So there's a distinction between the two. You may have a high interest rate risk rating as one of the 7 risks, but that does not translate, and this is to repeat what Jonathan already said, that does not translate, number 1, into a door. It doesn't translate into a de-risking plan. And if your risk management is very strong, would be positively reflected in the S rating of CAMELS. Thank you, Susan.
Thank you, Tom. Our next question is, do you see potential impacts to liquidity, and is NCUA doing anything relative to its review of liquidity risk?
Susan, this is Rick, and I'll take that question. So higher rates could have a large effect on liquidity. One of the problems with higher rates is these investments that a credit union might have normally used to raise liquidity, they might be underwater, and it might not be economically feasible to actually raise liquidity with them. So there are these potential impacts on liquidity by raising rates. Not only that, what are deposits going to do? We don't know whether or not we're going to lose, the credit unions are going to lose deposits, and that's one of the reasons in the job aid in the IRR workbook we have examiners focusing on other risks, and liquidity is one of them. Another one is credit, and whether or not the credit union is adequately monitoring their liquidity risk, their credit risk, so these higher rates don't the effects of the higher rates don't flow into these other risks, because as asset valuations go down, that's the worst time to have to raise liquidity. So NCUA definitely is looking at that. We'll look at it. The more interest rate risk there is, and the more we will, or the closer examiners probably will look at it, because there's probably a larger cost for liquidity at that point in time. That concludes my answer.
All right. Thank you, Rick. All right, let's see. Sorry about that. There's a lot of things to sift through here. How about this one? What would you expect to see at a supervisory committee level related to IRR? What should they receive, review, etc.? Does anybody want to take that one?
Susan, I'll take that. And I think we're actually quite clear on the involvement or the engagement of the board and senior management in terms of receiving information about interest rate risk. And this is also in our interest rate risk workbook and our examiner guide. So it's extremely important that the transparency of analytics, emerging risks, how the asset and liability composition of the credit union is changing to contribute to those interest rate risks is very important for the board and senior management to understand, as well as the assumptions that the credit union is undertaking to develop those NEVs and or earnings at risk projections. Because don't forget, and we're spending a lot of time on NEV, examiners not only look at net economic value, right? Earnings at risk is an equal, if not as important as economic value in the assessment of a credit union's interest rate risk, along with measurement systems, risk management, and how they're stressing their portfolio for different curve scenarios and assumption scenarios. So I think that helps to answer that question, Susan.
All right, thank you, Tom. Okay, next up, what weight will examiners place on internal models versus supervisory test models? Who wants that one?
This is Jonathan Farrell. I can take that. A credit union's internal model provides the inputs for the supervisory test model. Therefore, a large amount of weight should be put on the internal model for all assumptions other than non-maturity share assumptions. Examiners will focus on the non-maturity share assumptions to determine if the credit union is considering the uncertainty of interest rates and the economy. A credit union with well-supported assumptions and low qualitative risk ratings may have the interest rate risk rating improved in cases where the market risk rating is on the lower end of the spectrum. Examiners will also note if a credit union's past changes to loan and deposit rates correspond to the beta assumptions used in the model. If the internal model assumptions contradict actual pricing practices, the examiners will cite such inconsistencies as a weakness in the interest rate risk management process. Thank you.
All right, thank you. Let's see. All right, can you offer some suggestions for a small credit union on what you would classify as strong risk management? Anyone like that one?
I can take that one. This is Jonathan Farrell again. For a smaller institution, and just speaking generically smaller without a specific asset size, I think it's important that, you have a solid policy and that following the policy. One of the challenges is oftentimes, policies tend to be set with an expansive space. Make sure that you're looking at your institution, the way that you're behaving, the way that you're pricing, and then evaluating your model assumption set relative to that. Make sure that your model assumption set back tests appropriately. And that if you are making changes to it, as you probably should be for this unprecedented rate movement relative to a historically flat rate environment, that you're making sure that you document those qualitative adjustments that you're making, just as you would in a credit loss model. Make sure that you are documenting in the minutes discussions about changes up or down, and that your risk rates relate to the actual risk tolerance and appetite of the board. It's not uncommon for smaller institutions who might feel they have a less sophisticated team for evaluating this or board for evaluating this, that they tend to give management a lot more leeway. Make sure that if your board needs some additional training to provide the type of guidance that you're giving it to them, and that you're communicating fully everything that's going on. Other than that, it's going to be kind of institution specific, depending on the types of products that you're getting into. But just making sure that if there is something that's material to your institution, a particular practice, that you're taking into account for it in your modeling practices, and that for those that sensitivity analysis you're doing on an annual basis, that you're using that to guide where you're better refining your assumption sets and focusing your time on those areas where you're going to get the most bang for your buck. And I think that's the short answer. Thank you.
Great, thank you. Okay, I'm going to turn it over to Tom now because we're at the end of our time here. Tom?
Thanks, Susan. And I'll answer one more question I saw about liquidating HTM securities and tainting that portfolio from an accounting standpoint. Of course, credit unions are required and obligated to operate under GAAP. I think, and so you might want to consult with your CPA or your auditors in terms of how you would go about doing that. But otherwise, we would not have an interpretation of GAAP in terms of the treatment or the accounting treatment of securities. So it's 3:30. We're up at our time. We really appreciate the questions, and we may not have gotten to every single one of them. We apologize, but however, we will, of course, get a log of every question that we received today, and we will consider that as we committed to doing, always considering the process of how to evaluate a SOUP test and its risk classifications and non-maturity shares going forward. So again, thank you for your time today. Great questions. We really appreciate the engagement. And we're happy that you could join us today. Thanks very much.